Hey everyone, this is chapter 13 and 14 from Trading Price Action Trends, Trend Lines, and Trend Channel Lines. I was going to do chapter 13, 14, and 15 together, but I think 13 and 14 do a good job of explaining the trend line conventions and how to draw them properly, whereas chapter 15 is more about channels and how to trade them. So I kind of separated 13 and 14 to talk about Al's conventions about how to draw trend lines and trend channel lines, and then all the bulk details of channels in chapter 15. Because a lot of the stuff in chapter 14 about channels is also repeated in chapter 15, so I just saved it for that chapter. So trend lines typically connect the lows of a bull channel. So if you look at the NASDAQ here, this is the daily chart of the NASDAQ. You can clearly draw a line that connects the swing lows of this rally, and it's pretty clean. So it's in a clean, clear bull channel, and the trend line is pretty obvious here. So as soon as you get these 2 points, you can connect the two swing lows and have a trend line and see if that's tested and respected a following time. Trend channel lines are along the highs of a bull channel. So they usually contain the price action within a channel, and it's usually parallel, but it can also be convergent, and it can be up, down, or sideways. So here, we're going to talk about the conventions of trend channel lines and wedges, but here, if you just drag a parallel line from this line here and place it on a swing high in between these two swing lows, then you get this white line that I've drawn here. And that would be a parallel channel, and you can see it's respected pretty decently. You can also connect the swing highs of a bull channel, and that's the red line here. And that also does a good job. So they tell kind of different stories, and so it's important to understand if you're going to connect swing highs, what to expect, and if you're going to use a parallel channel, what to expect. And we're going to talk about that in a later slide. But it's just an idea that we're creating a channel to contain the price action to tell the story of what's happening. And so here I say it can be up, down, or sideways. Here you have a convergent channel that is going up, so it's a bull wedge. Here you have a bear channel, it's a parallel channel, and it's respected pretty nicely, so it's a clear bear channel. And here you have a horizontal channel, so this is a sideways channel, and this is what Al calls a trading range. So now how to draw them. So we talked about trend lines being drawn across swing lows. So here, for example, you can draw a line connecting these lows. And now this trend was broken, and it formed a new swing low here. And then you can draw another line from this swing low to that swing low. And you would have to constantly readjust as the trend develops. So tight channels become broad channels, and then broad channels break and get retested. And so as the channel progresses, you would constantly draw lines across swing lows to see if it contains the price action and tells a good story of what's happening. Another way to draw a trend line is to first draw the trend channel line. So in this case, Al gives the example that you have one push-up, pullback, second push-up. So it's a possible start of a channel. And so at this point, you don't have this bottom line. You just have one, pullback, two. So you have 6 and 8. You have 6, 7, 8. And so what Al says to do is you can draw a line that connects the swing highs of a possible bull channel. So you can connect 6 and 8 and then take that parallel and drag it down and see if it's respected. So in this case, if you draw the trend channel line first using the swing highs and drag that down to get the trend line, because at that point you don't have 2 clear points for this bull channel. You have 5, which is possibly the last leg of the down move, but you're looking for 2 pullbacks of the bull channel. And so here Al says 7 and 9 are the 2 pullbacks, and you see how it reacts at the trend line. And so that shows that it's probably telling a decent story of what's happening. And so in this case, we took the parallel of the trend channel line and used that as a trend line. Now you can always readjust it. So maybe once you get this overshoot of the actual trend line, so you get a failed breakout, maybe you readjust it from 7 to 9 and then draw a parallel up and see if that's the new channel. So these aren't static things. They're going to constantly change based on what the price action is doing. And so the same thing applies for trend channel lines. So we talked about how you can draw a trend channel line across the swing highs and drag it down for the trend line. You can also draw a trend line and then drag it up for the trend channel line, which I showed with NASDAQ, and I'll show again here. So if you draw across these swing lows, you draw the trend line, and then you drag it up, you get a parallel. But in this case, once you get 38, so this high that reverses down, you can tell that it's not really doing a great job. So you have this swing low and this swing low. Al's typical convention is find a swing high in between those 2 points, which is right here, and it doesn't really do a good job. And so when you see that it's not doing a great job, you also have to be aware of the possibility that it's forming a wedge. And so in this case, you could draw the line across the swing highs. And so here you can see it's a pretty clear bull wedge. Now they're both correct. This could have channeled up like this and followed the red line. In this case, it didn't. And so what a trader has to be aware of is that the wedge, so using the swing lows and swing highs to draw a non-parallel channel will kind of, by definition, contain all the price action, but it also create more overshoots. So if you're constantly drawing trend channel lines using the swing highs, you're gonna get a lot more overshoots. But you're gonna be able to catch the wedges when they happen, and so you'll be more prepared for them. So it's useful to draw them anyways. And when you draw a parallel channel, so you take the trend line and take a parallel up, you'll get less overshoots. But when an overshoot happens of a parallel channel, it usually means more because overshoots of wedges are very common. And so if I extend this line across here, you can see that we have a very clear overshoot here. And so this obviously is significant because it's happening late in the trend. But if I take this line here and draw it across the swing lows and then take a parallel and put it up here, you can see that it does a decent job telling the story here as well. Not as good as the trend channel line drawn along the swing highs, but here you can see we still overshoot it by a little bit, but not as much as the wedge top by drawing across the swing highs. So if this overshot the parallel channel, it would mean a lot more than overshooting a wedge channel. And I talk about that a lot more in detail in chapter 15 about the progression of a channel. But I think that's important to know that you can draw either way, but you have to understand what is more likely and what means more depending on the channel you draw. So we want to try to create a channel that contains most or all of the price action, but also best represents the price action. That's the most important thing. So we want to make sure that it has an accurate representation of what's actually happening. And last thing here is that the trend line itself is less important than how the bars act around the trend line. So we want to draw the trend line to know where we should expect something to happen, but we don't want to make decisions just because the line is there. We want to see the behavior around the line. So here in the example where Al shows the trend channel line and then drags it down, you can see that there's a reaction there and that the bulls are buying there. It's a reasonable spot for the bulls to buy, but you want to see the behavior around that line. And same thing here. You have 11 and 12. So you take that trend channel line, you draw it across the swing lows, and then you drag it to the top and you see how it acts. And when you see 13, Al says 13 is a good signal bar at that trend line that was drawn as a parallel of the trend channel line, and it's a reasonable sell. So the behavior is more important than the line itself. The line just gives you a reference point. So for the progression of a trend, Al talks about how trend lines are constantly getting less and less steep. So every bull channel is a bear flag, so it's probably going to break below the trend line. And every time it does, you get a new trend line that's less steep until eventually the bear trend lines become more prominent and it switches into a bear trend. Most breakouts will fail of a bull channel, especially as it gets more and more tight. So the tighter it is, the more likely a channel breakout will fail to the downside. And so strong bulls are constantly buying breakout attempts below the bull channel. But eventually when you get a really strong one, even then the first strong breakout, a lot of strong bulls will buy, and Al talks about that in chapter 15. But the strength of the breakout will determine if they'll take profits and start selling at a test of the extreme. So again, that's more for chapter 15, but the quality and the strength of the breakout is going to determine if we're going to get a major trend reversal attempt. But most strong bulls are buying strong breakouts from channels, expecting that the first one will fail, and that will test the extreme until it gets extremely broad and we have a credible major trend reversal attempt. So most trades should be taken in the direction of the trend. So here we have a channel on the micros. And so the progression of this channel is that when you initially just have these 2 points, you may start off the channel here like this. And as you see that it's not being respected in the way that you want, so it's divergent, so it's expanding. So we don't have a clear established channel yet, and it doesn't look like it's doing a good job. So you'd have to readjust that. So that might be how you start, but then you readjust. And then once you see that there's kind of a clear direction and that these lows are similarly spaced, they have a similar slope, you can draw a trend channel line across the swing lows, and then you can drag that up, which I did here. Now, initially, when you have these three lows here, it might be a little bit less steep at first. So like that, doesn't make much of a difference, like that. And then you drag it up to a reasonable swing high in between those lows, which I did here. And so now this is doing a decent job. Now we have a failed breakout above. Al says that when you have a random breakout above, you can ignore it if it's a quick breakout and break back in. But you also have to be aware that it might be now respecting a larger channel, a broader channel. So maybe you leave it here, maybe you raise it up and see how it acts. Now when we get this new high and then it sells off again, you might readjust it back to the original because that looks like it's doing a better job. So it's closer, it's containing more of the price action. And so now we have a pretty established channel. We get an overshoot breakout below the channel and it's pretty established. So that would be a credible overshoot. And so you'd expect it to get back in the channel and test the trend line. And so now you have a failed breakout above, respecting the channel again. So it looks like we had the right channel. And now whether you decide to readjust it based on this high, which would contain those two highs, like that, or if you keep it where it is, it kind of tells the same story. It doesn't matter if the flag is below. In this case, it's above. That would depend on your convention and seeing what you're more comfortable with. And then you'd kind of know how it behaves around the trend lines and trend channel lines based on your conventions. So the widest channel is the safest. So right now, if you're very conservative and you're not going to buy until it gets a clean break outside the channel, then that would be a more conservative channel to draw. And then you buy when you get the strong breakout follow through. Whereas if you're someone to use a tighter channel, then you already have the breakout here and now it's holding at the moving average. And so you might get earlier entries, but again, there's more overshoots with the tighter channel. So you have to be aware of that, the trade-offs there. This is September 21st. So we're just gonna go through this pretty quickly bar by bar and go through the iterations of what the channel could look like and how it progress. So the first thing that's obvious is that we have a horizontal channel, which is converging. So this is a triangle and it breaks to the downside. So obviously the day structure and context would play a role in how you start to draw your channel. So it's a big gap down, it's a climax. So we're probably gonna get some kind of trading range day. So it could be completely sideways range. It could be slightly upwards. It could be a broad bear channel. At this point, we don't know. But as we let it progress, so what we could do is we could start by extending this forward because we know that now we're breaking new lows. We have lower highs, so it's a possible bear channel. So we would take that line, and then the triangle's done. So I'm just going to erase this and drag this down to a swing point in between those two highs that I initially drew the trend line from. So this is a swing point in between those. So this is a general idea of what it could look like, but then it might take some adjusting based on how the price develops. So now we'll go through and we see that we're bouncing to the moving average, didn't quite get to that line, but still doing a decent job. And now we get a new low and bouncing and still doesn't get to that line. So at this point, when this starts to bounce towards the moving average, it looks like it's actually a less steep line than what we have drawn. So you could leave the channel as is and draw something connecting the swing lows, which actually does a better job here. You can see that it looks like it's forming a wedge of some kind. And here we weren't quite testing the trend line. So you could also redraw that so that it includes the most of the price action. So it looks like it wasn't really a broad bear channel like this. It was more a converging bear channel. So it was a bear wedge. So this is actually not as important here. So it looks like the first half of the day is in a wedge. It wasn't really a completed broad channel. And now we rally here. And so we have a decent reference point for the trend channel line with these swing lows. So traders will bring this up and go in between the swing lows. So this is one swing point. It could be in between these two swing lows, but that's obviously not doing a great job. There's also this swing high, which is in between these two swing lows. So we can drag that up and put it here. So that's doing a decent job. Now, right now it's finding resistance at the break-even test of the second entry sell here. So in chapter 15, I talk more about why this is the first thing that we should expect, that we should get a broader channel being formed. So I talk about that in more detail. But once we break this tight wedge, that is the first area where bears will look to find resistance. So they'll drag the trend channel line up and expect that we need to break through the break-even test and above this lower high before bears abandon the idea of a bear channel. So it might be forming a broader bear channel, which it is here, and we start to sell off from here. So traders can keep this line as is, or they can readjust it using these two swing highs now and drag that down. Oops. So we'll drag it to a swing low in between these two swing highs, so somewhere here. So right now this looks like it's doing a pretty good job. You can interpret it as just, at this point, just a broad bear channel, or you can see it as a bear wedge that broke out to the upside, and now we're getting a test of the low. So we're looking for a major trend reversal. But this channel seems to still be intact. And at this point, it doesn't really respect the channel. But it's established enough, and it looks like it's been respecting it for most of the day, that this would be a valid overshoot. So you can draw it this way. You can use this point and this point. You can also use the high of day and use that as the trend line, and then drag that down. So that also does a decent job. So there's no right answer. Both of these do reasonable jobs. This is actually steeper. So an overshoot from a steeper channel means more. So the wider the channel is, the steeper the channel is, the more the overshoot matters. Because it has to travel a further distance and be more climactic to overshoot a steeper channel. So now we're in an established bear channel and we have an overshoot. So the next thing traders will look for is a failed breakout below the channel and a move back into the channel, because after overshoots, we typically get a test of the trend line. And I talk about that more in chapter 15. So that's how you kind of walk through and adjust the lines. But how to actually execute trades based on that, we'll talk about in chapter 15. But in terms of drawing the lines, there is some experimenting and changing of lines, but you just want to get an accurate representation of the story. So some additional criteria. One thing that Al mentions is beware of tests that are part of the same leg. So here you could draw this trend line across 1 and 5, and then you get a test on 6, and you're like, okay, it has 3 pushes. But the distances between 1, 5, and 6 are not equal. And it actually looks like, if you're looking at the entire picture, it looks like it's a gap down sideways, so trading range, and then trend resumption down for a second leg. So it looks more like leg 1, leg 2, in that this is a spike for a small channel rather than a large bear channel, a broad bear channel, because you don't really have the points to support that. So it looks like 6 is part of the same leg as 5. And so right now you'd probably be best drawing from 1 to 6 and see if you get another test somewhere around here to show that you're getting evenly spaced tests with separate legs of the same line. Al says this is a little bit more dangerous because it looks like it's part of the same leg, so you only have 2 points. Now he still says that it's a reasonable buy because the risk is small and it's a second test, but just as a general criteria, it's best to get evenly spaced tests where it's a clear channel and not part of the same leg. So here it looks like it's more just 2 legs testing the same line. And also Al's convention is that when you draw a line across 2 swing highs here, like 2 and 3, you want to anchor it to a swing low in between those 2 points, and that would be here. And so that doesn't really do a good job of telling the story of the chart. And so when you drag it down, which Al has done here with the dotted line, it's still not anchored to something in between. So it's just not a good representation of the price action here. That's what Al explains in the book. The second point here is tell a story instead of connecting the dots. So instead of just connecting random highs and lows to form channels, it's important to understand what the actual story is and what's actually containing the price action, because that will give more meaning to overshoots and breaks. The third thing is to constantly readjust and see all possibilities, which we talked about. And the last thing here is to keep a consistent convention. So if you're using bodies for your channels, then use that consistently and learn the behavior around that. If you're using the full bar for your channels and you want to contain the entire bar, all the bars of the channels within your trend line and trend channel line, then do that consistently and understand the behavior. Because if you do that, then the overshoots are going to mean more, because now it's the first breach of the channel. Whereas if you're using the bodies, you're going to get a lot of breaches of the actual tails, but they may not meet as much because your channels are typically narrower and containing only the bodies. So it's best to have a convention that you use consistently and understand the behavior around those conventions. So that's it for chapter 13 and 14. Chapter 15 is much longer. It has the bulk of information about channels. So I go into a lot more detail about how to trade channels. So I hope this was helpful. I hope you find chapter 15 helpful as well. And I'll see you in that one.